All right, my guest today is Porsgaard, partner at Seed Capital, one of the most established early-stage venture firms in the Nordics. Chris started out as an electrician, co-founded 2 marketplace startups, and has worked across management consulting, M&A, and venture building in fintech, SaaS, and payments. Chris, great to have you here.
Thanks for having me.
Chris, you work at Seed Capital, which has been around since 2004. And for those who don't know about Seed Capital, could you give a quick intro to who is Seed Capital? And it's been around since 2004, so surely something must also have changed throughout that period.
Without a doubt, right? So it's as you say, it's more than 20 years, 26 now, right? And I cannot really say that I've been around for that long. Back in the day when they started, it was pretty much only Seed Capital who was around, right? So I think I'm not going to take you through the history of plus 20 years, but a lot has without a doubt changed, which I think almost every aspect is good things, right? So more funds means more back startups and so forth, and I think we're definitely going to come back to that, which I think is fantastic. But nonetheless, I mean, we're operating out of our 5th fund. I think as the name also reveals, to some extent, we are seed focused. We typically draw sort of a bell curve around seed stage. So we say we can go a little bit earlier. We could also go a little bit later, so towards pre-seed or Series A. We typically sort of lead rounds. That's also plays well into the fact that we are what we define as sort of a high conviction fund. So we only do around 20 investments per fund, which is quite a small amount when you are a seed stage fund. But what we do is that we really double down on the winners. So we also have more than 50% of our capital allocated to follow-on investments. And I would say those are some of the components that haven't really changed over the years. There's been some sectors which has come in and out and so forth, but high conviction, seed stage focused has not really changed a lot. I think what has changed, though, is in our 5th fund, we're going across the Nordics, which is a new thing. I think we're also going to come back to that because that is a little bit of a leap, which is fantastic and super exciting. And I think we have much to bring. I think we're going to come back to that as well. So that's sort of the short story. The sort of low practical thing is like we typically invest 2 to 4 million euros. We take a board seat. We, as I said, Nordic focused. We're a small team of 10, so I think that's the usual venture spiel that you're gonna get.
Yeah, you're right, Chris. We are gonna get to the whole sort of broader focus than mostly Denmark. Actually, let's just jump to that. I have because you've seen I have a bunch of questions here. Yeah, I'm very curious because you're not the first fund that goes from a local market here in Scandinavia and then expanding to the rest of the Nordics or the rest of Scandinavia. Yeah, I'm very curious how you think about this and how you're going to make that a success. At least my experience, and that goes both from being a Danish guy in Norway, seeing Danish funds try to come to Norway, and Norwegian funds trying to go to the other Scandinavian countries, that it's often very difficult to compete with the local funds because they're there every day and they get to meet the founders on the various events and all this. And sure, you can come into town, but it's not always the same. So I'm very curious about how Seed Capital is thinking about this and how you are gonna be sort of the first choice in the other Scandinavian and other Nordic markets.
I think that's obviously something that we've spent a lot of time thinking about, right? Because it is a pretty difficult sort of challenge, right? I think to be quite frank, I think we thought of it as the same way as we would sort of advise or discuss a market entry with a portfolio company, essentially, right? So I think first thing is, get up there and get to know the ecosystem quite well. So that is attending the events, meeting founders, meeting investors and angels and so forth. And I think that's the pretty basic part, right? I think the next part would definitely be to get feet on the ground. So and not only in the transactional sense. So we want to build sort of long-lasting, deep relations with quite few instead of transactional across many. So I think not to bash on any London-based funds, but I think just flying in, being there for 4 hours and asking what are sort of your top 5 portfolio companies that I need to be aware of is probably not the style that we're going to go for, and that's for sure. We want to get much deeper. We want to leverage the stuff that we've done in Denmark, which is exactly building very strong, deep relation, which takes time. But we're also quite aware that we know that it compounds. So we know when that happens and when you get there, you can really build a strong network. You can also build a strong deal flow from a venture fund standpoint. And that's really how we're going to get there. So essentially, sort of a two-step approach, right? So getting the intelligence and knowing the ecosystem, which is one. I think we are well in the process of doing that. And the next step would be to get feet on the ground to be there, because I think you are completely right. It's so important to be around and hear what's going on. In my view, at least, venture capital is investing in people. At least in our model, I would say, from that standpoint, you need to be there and build relations. So I think that's sort of the short story.
I'm curious to see how it pans out for of course seed capital, but also for the other funds doing this, and also which model will work and why and all this. But it of course helps that you have backed a lot of very, very cool companies. We're going to talk about some of those in a bit. Because one of the things I want to jump into here is what I call AI in the service industries. There's a lot of talk about the death of SaaS, or SaaS-mageddon, I heard someone call it, which I really like. And there are like two models emerging, or maybe they have been emerging for a while, but tech-enabled services and then service as a software. I have to keep my tongue straight whenever I say that, not to turn it around, but the service as a software. And you and Seed are investing in the space. So let's talk a little bit about that. Could you help me out with just giving sort of the definition as you see it for both tech-enabled services and then service as a software as well, and then go into a little bit about how you are viewing this from seed capital?
Without a doubt. I think, first of all, sort of the SaaS apocalypse, or whatever they call it, right, is in my view a little bit overblown, right? I think from public market standpoint, it's very radical at the moment, also giving sort of the geopolitical sort of situation and so forth. So I think, that put aside, I think there are some underlying dynamics, which is real AI, obviously, right? Which is interesting. But I think, taking a step back on that perspective, I think just knowing the fact that, whenever there comes a pretty big technological shift, some companies are going to thrive and some are going to sort of die out. And there's obviously some in the middle, right? So I think that is exactly what we're seeing now. Some is going to really thrive and do well, and some is going to die out. And I think that is what we're in the midst of seeing now. It's not all SaaS that's going to die in my humble view. And there's without a doubt people who are much smarter on sort of the public markets than me. So I'm going to leave it to them.
What do you think will make the difference? The ones that survive and thrive. What do you think they will do that those who don't survive don't do?
I think there's of course some funny sort of anecdotes around, make sure you're not on sort of Claude OpenAI's near-term roadmap, right? Then you're probably a little bit fucked, right? Which is a little bit of an issue for some companies if you look towards the public market. Figma being one of them, hit pretty hard just recently, right? I think, to be honest, I think not much has changed from how we look at, and we're not going to go into like a complete framework or anything, but we have a few pointers that we like to look at when we assess, back when it was a SaaS company, but also now when it's an AI company, and looking a little bit on sort of the resilience without making it too sort of VC lingo-like. I think just the fact, if you look at a business that is where we like to see a business, right, and where we think is interesting. So I think if you have a deep domain expertise within a vertical, I think that is definitely a checkbox. If you are putting yourself into a critical workflow with an embedded platform, I think that's also very much an important fact. If you are, and I think we're definitely going to talk about that with services, if you are within either a regulated industry, that's without a doubt a moat that is not really cracked by any LLM models or anything today. But also if you are in a industry where there's a high cost of failure or basically no room for mistakes. I think those are at least some of the things that we are looking quite a lot at when sort of assessing a company.
Vertical domain knowledge. Do you think that has become more important now? Because one of the things I've also been seeing is that many venture firms look a little bit less at the sort of horizontal software companies and the vertically integrated ones, because of context, because of domain knowledge, become more interesting. Is that also something you're seeing?
At least in my humble view, I think the obvious example is, investing in sort of a horizontal CRM system at the moment. would probably be a little bit of a bold move, to be honest. If you try to play around with Claude or anything, any of the other tools, I think you can see that you can play around and do a lot of damage and build a lot of tooling yourself quite fast, right? Which is also easy for sort of non-technical founders. When we talk to founders and angels and other investors, we are in sort of the epicenter of tech, right? So we are probably a little bit more leaning into using different tech tools, AI tools, and so forth. Whereas if you go to sort of the western part of Denmark, where it's more factories and service-oriented businesses which require physical and labor work, then a lot of them just haven't used ChatGPT at all, right? So I think just the fact that we're in the bubble, I think we can easily be sort of overspun by the idea that everything is going to die out. I think a lot of stuff is still happening on pen and paper, even in sort of the Nordics, where you are very much digitally sort of oriented, right? So I think just full stop there. There's a lot of businesses still running on very, very old systems or even pen and paper, to be quite frank.
It's going to take some time. That's fair. And I think you're very right. It's also with social media and stuff, especially LinkedIn. I tend to sometimes think, oh, everyone else is so far ahead. And then I realize, well, that's because I follow the people who are very far ahead. And that's... and then you start speaking to clients or people in your network, and you realize, hold on, they're still just testing Copilot right now. So it's things are okay.
Exactly.
If I could ask you to try to define tech-enabled services and then this service as a software.
I'm very bullish on sort of both models, you could say, and to be even more frank, I think it's essentially the same thing. It is really transitioning from the fact that you sell on a per seat basis, going toward outcome based models, right? Which is sort of the very simple statement made around basically both the different models, right? If you look at tech-enabled services, which we've made a few bets in quite recently, I see it very much as sort of, you need a human in the loop, and that human can probably produce, let's say, 10x the output that they usually could before, right? Take the example of a bookkeeper. They could probably handle like 10 clients, just a sort of a number I'm throwing out here. Now they can do 100, right?
How do you think this is going to hit management consulting?
Really hard. Essentially, wow, we did a lot of just, crunching data and also just not that hard analysis, just really crunching it together and putting it on slides. And there's, of course, the human element to facilitating stuff in between stakeholders. And that's obviously the part that's probably going to remain for some while, right?
I'm very curious about management consulting, by the way, because I've dug a little bit around, and there are exceptions, but there are a lot of the management consultancies or consultants I have spoken with who have not gotten very far with AI, which is a surprise to me. And I don't know if it's kind of like a little bit of innovator's dilemma. They're so busy, they're doing so well, and all of a sudden there's just someone else who's gonna shoot right by them. It could be that there's something I'm missing here. I've just been surprised that many of them haven't used it more. I would expect them to be at the very forefront of this. But I know it's a little bit guess also on the models, right? I mean, okay, management consultants don't sell by hours. That's more lawyers. I was trying to think, like, is there anything I'm not seeing why they haven't invested more in this?
Being an ex-management consultant, I think it's also a little bit of an obvious opportunity to sort of go fully sort of AI native on, all the processes, sort of collecting data, crunching it together, presenting it, all that stuff, just leaning into that. And I think we're seeing sort of a few of them pop up now in various extents. One fact that is probably going to remain when we talk about management consulting as a sort of a category is that many also hire a management consulting firm to do the stakeholder management around a specific problem, right? So I did, for instance, a lot of the cost out analyses. So basically cutting costs, very hard, right? Then it's much easier to sort of have a third party coming in and being really, really sort of harsh, bringing in the truths. Some of them is probably going to involve, cutting away a few heads and then reducing force, which is the very difficult conversations to have. So I think just the facilitation element around that, which is sort of the reason why you, without a doubt, also hire a management consultant, not only for the grunt work.
Yeah, it's a good point. And I think also read somewhere that is talk about sort of a bell curve and like in what kind of services will be this service as a software?
In my view, I think it's more where the software is the worker. So really, conducting the vast majority of the actual work, and you don't need sort of a human in the loop. In the longer term, the question is not really sort of what categories will be what, right? So where do you need at the moment in time, where do you need a human in the loop, and where don't you? To give an example from sort of our own portfolio, I think Embankment, which does fund services, is without a doubt an example in the first category. So software-enabled or AI-enabled services. I think what defines them is a little bit back to the stuff that we've been looking at, right? So they deliver fund services to a fund like us or much larger funds. So by the FSA, you're regulated. It's mission critical. It's high stakes, and these services have a very high cost of failure, right? So the example could be that our fund somehow managed to sell a company. We want to distribute all the capital that we want to return to our LPs, but somehow we do it in a wrong way. So the LPs get the wrong amounts, and it just goes wrong. This would be very critical, right? So a very, very big issue, and not something our CFO would be very happy about. And if you then take the other end of the spectrum, I think we've all seen sort of the initial pop-up of all of the sort of AI SDRs, which is, in my view, a little bit more of a point solution. To some extent, also much lower risk. So the worst case here is you lose a few leads. You might get some reputational damage because the AI goes nuts and writes the same people in the same organization a lot of times, and it goes crazy, right? Both categories are working in the same direction, delivering an output and not just software that to be used. And I think, to be honest, I think that the gap is closing quite fast, which I think is interesting.
Mm. Of course, you look more at new established companies in the venture space, but you also see like other sort of investor lenses like PE firms. They're looking very much now at these tech-enabled service companies that maybe have been around for a while, who have connection to clients, and then you can start applying tech to sort of deliver 5x, 10x, and just get completely different margins. And another thing I was about to say here, but let's jump into distribution. That's I think I bring it up in every podcast recording we do now. I find it very, very interesting. Things are just moving so fast in terms of how quickly you can produce things. How do you reach customers? It's getting flooded because now people can generate stuff with AI. How do you think about the importance of distribution when you look to invest in companies?
I think maybe sort of anecdotally, sort of from my own scar tissue, being an entrepreneur myself, right? Being a young university student, I think I made exactly the sort of first-time founder mistake of just building a product 3 times before we sort of managed to actually get it out to real customers, essentially. Of course, we did all the theoretical stuff and talk to customers. But I think it is very much true that sort of first-time founders focus on building the product, and second, focus on distribution. I think that's a very real thing. In that sense, I think I have learned that, and therefore, as a VC investor, focus a lot on distribution. And even now, I think it's more important than ever. Looking at distribution, it might, in some conversation at least, be somewhat simplified. So I think distribution might be sort of equaled to go-to-market strategy. I think there's sort of 3 elements to it. And I might be able to give an example with FlatPay, which is the obvious distribution example, right? So when we first met sort of Rasmus and Sander, the founders, the commercial founders, we also have Peter, the CTO. When we met the guys first, I think it was pretty obvious that these guys were absolutely insane go-to-market leaders, right? They knew every sort of strategic handle you could use to get your go-to-market to work, right? They had spent years refining the playbook. They, of course, also conveyed why FlatPay and the value proposition and the specific segment, which is the 2 other parts, why it resonated so well with their distribution model. And that was actually what we spent time on once we wanted to assess FlatPay, right? So it was pretty obvious the go-to-market part. We knew that. They founded several companies before that. We knew that stuff, right? But what we spent the most time on was the 2 other parts. So the offering they had in the market, would that resonate, making the go-to-market easier? And did it really resonate with the specific segment, quite narrow segment, so physical merchants, typically owner-operated, that they were going after? In that case, there were only one thing to do, and that was to get out and meet them, right? So I think me and my colleague Lars, who sort of led the deal, we went out and visited pizzerias and bars and florists, different sort of stores, to really understand how did the sort of the triangulation between them coming out in a field sales-based model, talking to customers and telling about the product, resonate with the actual sort of product offering, and what the needs were in the specific segment. And from there, all the sort of things that the founders told us just was super clear, right? We could instantly see they were, of course, completely right. Nobody wakes up as a small business owner on Monday morning and thinks, now it's time for me to look at a better payment solution, right? So you need to meet them out there, right? The second thing is they have no clue about what they're paying for the existing intransparent payment solution. My mother is a hairdresser herself and had one of the bigger incumbents. You can guess who. The fact was, when we dug into it, it was quite clear that she was getting ripped and, had a long contract period, which she couldn't get out of, right? So those things sort of tied together, I think it was quite clear that not only the go-to-market part of the distribution, but the other things resonated extremely well, which was sort of where the magic happened and has happened ever since.
And are the different distribution examples that you value? Like, one is this, that they really understand the potential clients, they go out and they meet them where they are. And I assume, again, if you have a buyer that doesn't go online and search for payment solution, all this, that there's some sort of also moat in that network and distribution they build that way. And of course, their market knowledge. Are there other types of distribution where you see, okay, this is really strong when you meet cases and this is defendable or has a moat?
So that's just one example of a very sort of specific go-to-market motion, which is obviously the field sales, sort of high volume push-based model. I think there's, without a doubt, also PLG motions, which resonates and works extremely well. The fact is that it's still around, baking in exactly the value proposition to customers and experimenting a little bit, about what is that actually, right? So I think taking another example from our portfolio where we really start to see things moving is Understory, basically operating system for experience providers. So also in the SMB sort of mid-market segment, they started out by selling sort of a pure operating system, which, made it much easier, much more efficient, all this stuff, right? But now they just launched Bloom, which is a sort of a grow product. So the operating system was really about, how do you make your business much more smoother to run? But now when they launched their Bloom product, so their growth marketing product, now you can also help put money in the pocket directly, sort of top line in the pocket of the customers, right? And here you're starting really to see things move, right? It's also it's much easier to sell something that puts money in your pocket than selling something that takes cost out, essentially, right? And makes your business easier. They've really sort of nerded down on exactly what the value proposition should be and sort of designing a no-brainer offering, so to say, where we had exactly the same sort of discussions with one of the previous portfolio founders, where he was playing around with how do we actually design exactly sort of the pricing offerings, sort of the onboarding process to the specific segments, right? And it's really about nerding into it. And then at some point, you usually see that it starts to work, right? Which is easy to say, but very hard to do.
The personal connections, the network, the brand is also something that I think is very, very interesting. Like the importance of brand when there's so much noise. We've been talking about venture cases and startups, but as a venture capital firm, being Danish, I know C Capital very well because you've had so many success stories and been sort of one of the pioneers within VC in Denmark. But how do you build your brand when you're now going to the rest of the Nordics? Is that something you think about? I started asking these questions to the venture capital investors, like because you see many of the founders have these, Anton Osika from Lovable is a great example of this. And you see this in many cases that they become very active on LinkedIn, have a great following. As a venture fund, how do you think about that? Because I guess there's also something about reaching these audiences and being seen, or maybe not. Maybe it's more the secrecy and like being a little bit in the shadows. I don't know.
Yeah. I think if you were to look at sort of the US a little bit, right, I think the two obvious examples to sort of pull out is sort of a benchmark versus more of a Sequoia or A16C, right? So A16C and Sequoia, doing almost a podcast daily, probably in news articles and, massive events and camps and, all that stuff, versus Benchmark, which is very different, right? So just taking a look at the website, then you get a feeling of how different it is. For us, thinking about brand is a couple of different things, right? So I think one of the most important elements which we've been talking about is basically leave a brand impression through the relations that we make, right? So when I talk to you, maybe not on the podcast, but at least, as you could say, off screen, so to say, we want to leave an authentic feeling of who is Seed and what do we stand for. Of course, you can do all sort of the bells and whistles with the events and articles and videos, and we want to do that, right? That's obvious sort of marketing tactics. But the most important thing for us is that people get sort of an authentic view on who are we inside Seed. We believe venture capital is a people business. At least in the model that we run, where you are a high conviction fund, there you need to build meaningful relations beyond just the fact that you put in money. And that is very much sort of our view on branding. It's much more than the bells and whistles and collabs and all that stuff. It's also sort of the impression you leave in the one-to-one interactions.
The next section here is a little bit about the Nordic ecosystem. If you had to make 3 bold predictions for the Nordic startup ecosystem over the next 2 to 3 years, what would they be?
The general sort of first one is that I am extremely bullish on the Nordic ecosystem. There's just so much stuff going on. I think just this Friday we had a internal fintech event, just community-based, invited people, and sort of the buzz and how people are building now is just absolutely fantastic. How the ecosystem, just in the 4 years I've been here, is really coming together. That is, first of all, very, very interesting. And I think to some extent it's even stronger in Stockholm.
Do you think that's also because of sort of a flywheel effect that you've seen some awesome cases? Of course, Stockholm is just another planet, right? But in Denmark as well, you've seen a lot of really, really good cases, and then these people start sort of being recycled, so to say. That sounds really bad, but they start going back into the ecosystem, all their knowledge and all their sort of skills, and then you sort of get this effect going.
That is exactly what it is. I think my second sort of prediction is that we're going to see the ball rolling on exactly that. So you could call it sort of the mafia, the PayPal mafia effect, right? Where we are seeing ex-employees, maybe early employees, maybe late, that doesn't really matter, coming out and building new businesses. So we've seen that across sort of some of the portfolio companies. So Vivino, Trustpilot, Lunar, people popping out, wanting to take their own journey. I think this is, without a doubt, a very, very strong effect, which yields, new businesses, attracts more capital. I think it's really sort of self-enforcing, which I think is sort of fantastic. If I then should highlight sort of a third, slightly a little bit more negative sort of statement or prediction, what we're seeing now is that some of the larger funds, also some of the more local funds, pumping very, very high amounts of tickets into extremely young founders who have very, very little experience in running a business. This is something that we at least are very mindful of. I know that some are leaning extremely well into it. To be honest, I'm very skeptical around the fact that you give 5 million euro to 2 university students that, haven't built a business before. I think there's much more to building a long-term sustainable business than generating sort of a initial prototype and selling to the first few customers, if they even have that once receiving the 5 million euro. I think building and scaling a business where you need to hire and fire and take very, very difficult decisions and negotiations with suppliers, I think that is very, very different. So I think what we're going to see is some of them, which is going to go nuts, and go, all the way, which I think is fantastic. We've also seen that in our portfolio early on. But I think without a doubt, you will also see a big amount not able to sort of cope with getting a lot of money very, very early on, knowing how to manage it and essentially build a sustainable business. This is definitely an aspect which I am a little bit sort of worrisome about, to be honest. It's fine if it's just play money, and that's good if some funds can handle that. but I think it's something that you shouldn't really be sort of neglecting. Also, if you were a founder coming out of university, it doesn't really hurt to go out and, be in an established startup, right? Taking the journey with a founder who's tried something before. I don't think that hurts at all. And right now, it seems like a lot of young, super ambitious, and also much smarter than me guys and girls are coming out and raising quite big amounts, which I think can hurt them to some extent, or at least be very mindful of that.
Yeah, because let's play out that example. One guy and one girl, 19, super smart, super ambitious. They have a fantastic idea. They're pitching to you, and you think this is fantastic, and they are fantastic. The valuation is pretty high. They want to raise a pretty big amount. I know it depends on the case and all this, but like, would you try to say you should actually try to bring in someone experienced, or do you look at, okay, who are they? Are they both technical founders? That's where the age matters even less these days, right? That it might even be an advantage that they're younger with AI versus like they're both commercial, depending again on where they're selling to. Might be more tricky. How do you evaluate a case like that?
Generally, it's not like experience necessarily equals, sort of fantastic founders and great outcomes. I don't think that at all, to be honest. Especially don't think the fact that, hiring somebody with a fantastic resume, getting them into sort of an early stage company is the magical formula. To a very high degree, quite the opposite, right? Now, if they are sort of pre-product, pre-revenue, it's probably not for us, right? But nonetheless, I think it's without a doubt the fact that give yourself the room to sort of experiment, right? If you recall, I also worked a little bit in a venture studio, and the only thing you did there was really sort of iterate around an idea until you sort of got to something that smelled like product market fit. I think once you receive, a 5 million euro or even, in some cases 3 or 4 million euro or even bigger, right? It's very, very difficult because there will be pressure from growth rates at a very high sort of revenue level or AR level once you will go into the next rounds. Because you will obviously look at sort of capital efficiency and so forth, even though it's still early stage. I would recommend generally, a smaller amount in, allow yourself to experiment, and you will get there. Once things start, sort of the ball starts rolling and you see product market fit, you see the first customers coming in. It's more about not being sort of forced into a very, very difficult sort of fundraising journey by going out and raising very big rounds on very, very little. I think it puts an enormous pressure.
I would argue also that when you get a little bit beyond seed, that there's very much in the AI race, there's also a sort of market capture play here.
Exactly.
At least I've seen quite a few cases where it's just like whoever gets there first, because there might be some differences in the product, but I don't know how much the customer actually sees those differences. So whoever gets here first will get them.
Yeah, I think that's completely right. It's very difficult. I've tried that, myself, right, to some extent. Selling a product that doesn't really have product market fit. That's not fun. I mean, it's really not fun. It's really, really stressful, right? From that standpoint, and that is obviously, I would say pre-seed or even earlier kind of style, right? Where it's not fun. And I mean, like, I would just much rather see them being super diligent around experimenting and learning. Sort of in our process, we typically meet founders quite early and follow their journey. I would much rather see that they are experimenting and doing very, very well on nailing things down and finding the right path than them sort of brute forcing customers in on their product, either to see them churn or just see them be so widespread that you don't really have sort of a very focused ICP.
But if you go back to the question about age, again, I know it depends, but do you advise them to find someone with more experience to join them, or is that something you try to build into the board, or do you use advisors as a venture fund that you sort of connect them with, or how would you actually try to solve that or to mitigate that if you just see the potential is definitely here, but I'm afraid that these two 19-year-old kids, if you will, young kids, or not young kids, older kids, that it will be too much for them to have to scale this up and down with everything that it takes?
Or I at least like to use sort of the anecdote around, when we invest in sort of founders, we invest in them, right? So we need to have sort of a core belief in they're going to take it all the way. No matter whether they're 19 or 99, we believe in them, right? So I wouldn't even put us anecdotally on the co-driving seat. I would put us sort of in the back, right? We could probably at some point in time, we can whisper something in the ear that, you might need to talk to somebody who's tried sort of this part of driving a business before. Let's say it's the go-to-market part, right? We might have some that is just a little bit in front of you in the journey. Say, here are 3 names. We think you should talk to them and learn as much as possible. So we would never sort of say, now you need to go out and hire sort of a X super sort of high caliber profile and get that into the company. It's much more about getting the right advisors and people in front of them, and then believing that they will make the right decisions. Because ultimately, we want to invest in the people that makes the best decisions. Right?
You're about to run out of time, but I have one last question. You've started a company, actually not one, but 2 companies right before. Now with everything you know now and everything that's going on with AI and in the world, if you were to start a company tomorrow, what would that be?
Living in this sort of time of the world, I think if you don't sort of have the builder's fever almost every day, I think there's something is wrong, right? Which I obviously have, right? So I think like many others, I have a small list on my iPhone with probably 50 or something ideas where the vast majority is really bad. I'm 100% sure of that. I have something about sort of the construction industry. Being, as you mentioned in the beginning, I'm an electrician by trade, sort of in the early years. I just saw, and even though it's quite a few years ago, what AI could do in a service business, obviously. Just building sort of everything from capturing customers to sort of how you run your resource management, to how you purchase your equipment and the materials. I think there's just so much to be done there. So that is a little bit sort of a dream that I have to sort of go deep on that part. And then another more funny one, I think, I've personally been part of planning, probably 2 or 3 of my good friends sort of bachelor parties, right? It's, you need to figure out the guests, you need to figure out who can attend, what date, what activities, how much will it cost, how do we schedule it, how do we receive payments, communicate. It's a mess, right? A little bit back, I tried to sort of vibe code my own sort of bachelorette party planner just for the fun of it, which I obviously, just learned a lot from. It was more sort of taking the experiment of vibe coding and building stuff myself, which I thought was fun. So that's at least 2 ideas here.
I can tell you I was inspired by the company you've invested in, Nordics, reading up on what they do and helping with sort of find the right pension insurance and all this. And I thought it probably exists already, but for my own personal insurances and stuff, that's someone where I could just feed in all my policies, study it, ask me questions about what I need, and then help me negotiate, because they make it purposely, I think, so complicated that you just like, I don't want to deal with it, and then they keep raising price.
You're so
anyway,
right.
That's I don't think that's gonna be any unicorn anytime soon, but it's
you have your first customer right here, that's for sure.
All right, Chris, thank you so much. It was fantastic to talk to you.
The same.